Hey everyone, Mark Rusin here. I'm a CPA and not a financial advisor, and everything that we discuss here on this channel revolves around dividends, passive income, and building wealth in a reliable and safe way. If you love those things, then do us a huge favor and click that like button down below, as that is huge for the growth of this channel moving forward, and consider subscribing if dividends, passive income, and building wealth is something that intrigues you. The stock market has performed quite poorly here in 2022, with the greater S&P 500 down 15% year to date. For the month of May in particular that we just got through, stocks were relatively flat, almost flat exactly on performance for the month, but we are still down and digging ourselves out of a hole. Pain is one way to look at the market right now, but for long-term investors like you and me, this can be looked at as an opportunity. We are seeing prices that were last seen in 2021, and some stocks we're seeing prices that were last seen in 2020. Some stocks that are out there, high quality, blue chip, cash flowing, dividend paying stocks, some of them are trading at great valuations for you to get in and to layer into over the next coming months. There may be some questions out there right now in terms of why we are seeing so much volatility and poor performance in the stock market. Let's go through a few key items right now. Number one, inflation is at an all-time high. We are seeing massive inflation, and this means that the goods that you go buy at the grocery store are just costing that much more. Or we can look at fuel prices that are just going through the roof. This could be in part to the Ukraine-Russia war that's going on right now, but in all honesty, gas prices were moving higher well before that. And lastly, the third thing is the Federal Reserve. Jerome Powell, the Fed chair, and his team are embarking on a new monetary policy. We are seeing rising interest rates in addition to bonds that are being sold off. So what the Federal Reserve did, especially during the global pandemic, is we saw record low interest rates. Interest rates were relatively pretty much zero. And we also saw the Federal Reserve buying tons of bonds, pumping funds back into the economy to prop up the stock market. All of these things are headwinds for consumers, which in relation can be headwinds for certain businesses. Right now, businesses in the energy sector are performing quite well. But in today's video, we're going to take a closer look at 3 dividend stocks for you to look at for the month of June. So hopefully you've already clicked that like button for us. And with that being said, let's dive into the video. As always, everything shared in this video is for educational and informational purposes only, so please perform your due diligence before investing in any stock mentioned today. Also, if you're looking for a great new investing platform, then definitely check out M1 Finance. I will put the link in the description down below, but M1 Finance is a great platform for you to try if you are a long-term investor. You are able to transfer over any of your stocks that you have on other brokerages. Say you have stuff on Fidelity like myself, or Vanguard, anything else over there, Robinhood, you can transfer those out without having to sell. And for every new account that you open, M1 Finance will drop in some free cash just to help you get started. So definitely check out the link in the description below. With that being said, let's take a look at 3 dividend stocks. In fact, we're going to take a look at 2 dividend stocks and 1 REIT for you to consider buying here in the month of June. The first dividend stock to consider is T. Rowe Price, stock ticker TROW. T. Rowe Price is one of the largest asset management firms in the US today. As of their latest quarterly report, they have assets under management of $1.55 trillion. Much of the success of T. Rowe Price is tied to the performance of the stock market. T. Rowe Price has an array of different funds. Much of these are through 401k programs. But when you invest in a T. Rowe Price fund, they charge you what is called an expense ratio, or a management fee, you can think of it. It is based on a percentage of what you invest. So if it's a 1% fee and you have $10,000 invested, they will earn revenue of 1% on your amount invested. So much of the success of T. Rowe Price is tied to the performance of the stock market. So right now, when we've seen the stock market down and in the red, approaching bear market territory, or in bear market territory if you are referring to the NASDAQ, you can understand why shares of T. Rowe Price or the company is performing poorly right now. But in the long scheme of things, if you look out, you will not see the S&P 500 have a negative outcome over a 20-year period. So this will not continue forever, where the stock market will just continue to go down and go down. That's why right now provides a great opportunity to pick up shares of T. Rowe Price. At the end of April, we did another video covering T. Rowe Price as one of the stocks that we were mentioning. And in that video, we discussed in Q4 that the cash outflows the company was seeing was one reason why we saw the stock coming down. In Q4 of 2021, the company saw cash outflows of $22.7 billion. And if you think about it, if there's not money in there to be invested by clients, then they don't have the opportunity to earn that expense ratio or that management fee. So in Q1 2022, which we just saw them report recently, the company saw net cash outflows of $5.3 billion. So that is slowing there. We went from $22 billion down to $5 billion. So that's a good sign, and that's number one. Given all of these cash flows that we've seen coming out, the company still eked out a 2% management or 2% revenue fee, I should say. And in terms of the stock, looking at the chart here, shares of T. Rowe Price are down 35% on the year, which makes sense given the overall market is down substantially. Remember, T. Rowe earns fees based on the amounts invested in their funds. However, again, if you are a believer that the broader S&P 500 type market is going to succeed in the next decade or so, then you can bet on T. Rowe Price performing much better than it does right now. On a forward-looking basis, shares of T. Rowe Price currently trade at a price-to-earnings multiple of 12 times. Looking here at the fast graphs chart, you can see that over the past 5 years, which will be the blue line, shares of T. Rowe have traded at an average PE of 15 times. Analysts are already expecting losses here in 2021 before the company is expected to return to growth of 7% in 2023. Turning to the dividend, this is where T. Rowe has been a beast. The company has an astonishing dividend track record, having increased the dividend for 36 consecutive years now. That is longer than some of you watching this video right now have been alive. The company pays a dividend of $4.80 per share, which equates to a dividend yield of 3.84%. The company also has a very low payout ratio and very strong dividend growth rate of 15% the past 5 years on average. So not only are you getting the opportunity to buy shares of T. Rowe Price at a discount, considering well the market is right now, that is providing the discount on shares of T. Rowe, but you're getting a high quality blue chip type company. It's very well run. You're getting an increased dividend, and it's a safe dividend. They have a very low payout ratio. So definitely take a closer look at shares of T. Rowe to consider adding to your portfolio here in the month of June. The second dividend stock that we're going to look at today is Bank of America, stock ticker BAC. Bank of America is not only one of the largest banks here in the US, they are one of the largest banks in the world. They trail in terms of assets, they trail only JP Morgan. As of the company's most recent quarterly earnings report, the company showed that net interest margin grew $1.4 billion to $11.6 billion in total, which is an increase of 13%. When looking at banks and financial institutions like it, you want to take a close look at net interest margin, or net interest income, I should say as well. And this is really the difference of when you put deposit money into the bank, they're going to take that money and they're going to pay you a small fee, 0.000025 pennies on the dollar. And then they're going to turn around and take your money and lend it out. Think of loans, mortgage loans, business loans, anything like that. And the difference is how much interest are they receiving on the loans they're giving compared to how much interest are they giving you, the person that's depositing the money. The difference between those is the net interest income. So as I mentioned, the net interest income in the latest earnings report grew 13%. A couple of reasons for this. We saw deposit growth, so more money was being deposited into Bank of America accounts. That grew $8 billion. We also saw loan growth. Again, we're able to give loans out at higher interest rates right now, and that grew $14 billion. Bank of America has been a very well-run company, and they pride themselves on returning money to shareholders. During this quarter alone, the company repurchased $2.6 billion in share repurchases, and they also spent $1.7 billion in dividend payments. So as we already know, and I mentioned it earlier with the Federal Reserve, interest rates are rising. And this is great for a company like Bank of America. They're able to take the money that folks are putting in to their deposit accounts, and they're able to send that out and get loans for higher interest rates. Just think about it. Just the past 6 months or so, we saw mortgage rates that were down below 3%. Fast forward to today, and mortgage rates are roughly around 5.5%. And that is huge growth, especially for net interest income purposes when you think about it that way, for a bank like Bank of America. Bank of America is one of the banks that's going to benefit most from interest rate hikes here, just based on the number of loans that they have out on the market. Looking at the chart here in terms of BAC shares, the stock has traded in lockstep with the S&P 500 for much of the year, which poses great opportunity, in my opinion, to add shares of this blue chip financial institution. Year to date, shares are down 20%, meaning the stock is in a bear market territory like many of the other S&P 500 names. Looking at the forward earnings multiple, you can see that shares of Bank of America trade at a multiple of 10.8 times. Looking here at this fast graphs chart, you can see that shares of BAC have traded closer to an earnings multiple of 14 times over the past 5 years on average, suggesting that shares of Bank of America are very undervalued. In terms of the dividend, the company has been amazing. The current yield is roughly 2.3%, but it has been growing at a 23% average clip over the past 5 years, which is amazing growth. The company pays a generous dividend, a growing dividend that appears to be very safe with a low payout ratio. The third dividend stock is a dividend stock, but it is also a REIT, a real estate investment trust. And that we're going to discuss today is WP Carey, stock ticker WPC. For those of you that have followed me on social media and here on YouTube, you know that I love REITs. I aim to have at least 20% exposure to REITs. When you look at it over decades and decades, REITs have been one of the, if not the best performing asset class for investors to invest in. REITs are a total return investment. And with WP Carey, WPC, it is no different. It is a very well diversified REIT. They have properties that are within the industrial space, the warehouse space, the office space, the retail space, the self-storage space, and other spaces as well. Here is a quick snapshot of the entire portfolio. As of the most recent earnings report, the company had 1,336 properties that were leased out to 356 different tenants. The portfolio as a whole equates to 157 million square feet, and the annual base rent is $1.3 billion. Diversified in property type and geographical location as well, with 63% of the ABR here in the US and 35% in Europe. You could see that they have a nice long weighted average lease term of 10.8%, and the company ended the prior quarter with an occupancy rate of 98.5%. The top 10 tenants make up 20.2% of total ABR, and here is a look at those top 10 tenants. You will see U-Haul, followed by government buildings in Spain, Extra Space Self-Storage, Marriott, and Advanced Auto Parts, to name a few. The diversity in the portfolio is one thing that attracts me to shares of WPC. The other thing is how their leases are agreed to or entered into. Did you know that WP Carey, 99% of all of their leases have built-in rent escalators? This means that every single year, tenants are going to pay a higher and higher rent. Some of these are fixed fee, some of these are percentage increases, but as you dive in more, you will see that 58% of those rent escalators are tied to CPI, otherwise known as inflation. And if you've heard anything about inflation of late or just gone to the grocery store, you know that inflation is red hot right now. So this is a major tailwind for a company like WPC. In terms of the stock, shares of WPC are up 2% year to date. Yes, we are looking at a stock that is actually up on the year and is actually up 7% over the past 12 months. The stock trades at a forward price to FFO of 16 times, which, remember, with REITs, we do not look at EPS. Instead, we look at FFO, which stands for funds from operation. This takes a closer look at the actual cash flows for the company and takes out the impact of something like depreciation, which is a non-cash expense. And with real estate, depreciation expense is very high. Looking at this fast graphs chart, you can see that over the past 5 years, shares of WPC have traded closer to 15 times, suggesting that shares are fairly valued. However, the company has gone through an overhaul where in the past they had an investment management arm. They still do, but that is winding down. The company has done a lot in becoming more of a warehouse and industrial focused REIT, a diversified REIT first and foremost, with an emphasis on industrial and warehouses. Just seeing where the economy is going, seeing how many more companies are going online, and especially with the supply chain issues we've had now, we are going to see more and more companies take on a little bit more inventory so we don't run into these issues in the future. When you take a look at other warehouse focused or industrial focused REITs, something like a Prologis, stock ticker PLD, or Duke Realty, stock ticker DRE, these companies are trading at FFO multiples higher than 25 times. In fact, for a while now, they were over 30 times as recently as 2 months ago. Who is not to say that someone like WP Carey, should not be trading at a multiple closer to that? I'm not saying that they should be trading at a 30 times FFO multiple, but they certainly shouldn't be trading at a 16 times multiple. That's more in line with something like a net lease REIT that has shorter term lease rates. Think of something like Realty Income, which already gets a premium, but WPC doesn't even trade at a multiple of that of Realty Income, which is a retail focused REIT. Realty Income trades closer to 18 times FFO multiple. So although WPC Carey is getting closer, I believe that should be the floor in terms of multiple for WP Carey. And it should be, in fact, closer to these warehouse REITs. So the opportunity is there for multiple expansion. In terms of the dividend, being a REIT, you typically get a little more in terms of yield. And in fact, WPC pays a dividend yield of 5.1%. So you're getting a very high yield with shares of WP Carey, and the dividend growth is not really there like we see it on other companies. But the company has, however, grown the dividend now for 9 consecutive years. So there you have it, folks. 3 dividend stocks, 2 dividend stocks focused, and 1 REIT to consider for the month of June. We have T. Rowe Price, which is going to be more institutional as it's focused on how the market's going to react. So right now you're getting that pullback, and it could be a great opportunity for you to add it to a company that's growing their dividends at a very strong clip. Next, you have one of the largest US banks or largest banks in the world, also a very strong dividend paying stock. The company is growing that dividend at a very strong clip. And as interest rates rise, the net interest income that Bank of America is going to continue to earn is only going to rise with it. And lastly, we looked at a REIT, WP Carey, a very diversified REIT with a focus on industrial and warehouse type properties. It has multiple expansion opportunities there. You're going to get a high yield. It's a very well run company and trading at a discount in my eyes. So definitely do your due diligence when in looking at all of these stocks. And let me know down in the comments what stocks you are looking to add to your dividend portfolio here in the month of June. I hope you enjoyed the video, and if you haven't done so yet, please click that like button and consider subscribing. And with that being said, we will see you in the next video. Take care.